Man.
Welcome, everybody, to the Chinchilla Pickin' Podcast. It is March the 1st, 2023 at 7:50 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here joined by Brandon Beaver. Brandon, how are you doing, man?
I'm great. And I just lied to you. I don't have anything for the show.
Nice. This is going to be a fantastic program we're putting on for you tonight, then.
And it's going to be 2 hours, and it's going to be just me reading CNBC headlines and StockTwits posts.
You know what? Hold on. I could stand to listen to StockTwits posts for 2 hours because some of them are hilarious. All right, that would be actually kind of cool. But the CNBC headlines, not unless we're gonna dissect them and go into them. But the StockTwit posts, we need to bring that section back of our show. That was a fun section. Reading StockTwits from the past week. I might try to write some down this next week.
2 hours of everything that Jim Cramer got wrong.
That's not enough time for the past week. That's not enough time for the past week. Oh man, I don't think that's everybody gets stuff wrong. I'll give him that much credit, but I mean, lately he's been on a hot streak the opposite way. No, I tell you what, it is storming here. I got storms outside my window, and my family members on the West Coast, they have storms outside their window. And we're texting back and forth, and I'm like, "Hey, you guys are down the street from me, right?"
Yeah.
Just because they're taking pictures because they're in Southern California and San Diego, and they're like, "Look at this, we got hail, guys! Whoa!" And they're just all in shock, and I'm like, "Yeah, that's just called weather where I'm from."
Huge funnel cloud / tornado yesterday over near Oxford, right down the street from my girlfriend's parents' house.
Yeah. All right. So, serious note here. I want to bring it down to a serious note. We do have a lot of listeners from the Cincinnati metro area. If you do know someone who was impacted by the tornadoes recently in Middletown, Trenton, that whole area of our the Cincinnati area, let us know. We'll be happy to reach out and help in any way, shape, or form that we possibly can. That's 100% serious note. Let us know. We'll come out there and we'll see what we can do to help out and lend a hand. Anything we can do, guys. That's serious note.
I will even physically exert myself.
That's rare for Brandon. He is. If you've ever met him, you would be like, "Yeah, you don't exercise at all, do you?"
I'm currently working on being the cover star for a new cereal called Dioedes.
There you go. All right, so people don't want to hear us talk about this all night, guys. They want to hear us actually talk about financial, investment, and stock news. So let's get to it. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We do not discuss it. You hear the live discussion here on the show. However, today we did not even tell each other what we're going to talk about. Yet again, we're going to pull this off live right in front of us. Brandon has 99.9% of the show. So, Brandon, take it away.
All right. Lowe's reported earnings today, down a decent amount after earnings. I don't remember the percentage that they're down, but whatever. It doesn't really matter. It's not important to what I'm talking about. Anyway, I just wanted to get into Lowe's earnings here. With the negative housing outlook and dampened consumer outlook for the year, because I just wanted to see what they had to say. Now, earnings per share did beat $2.28 adjusted versus $2.21 expected. Revenue was down $22.45 billion versus $22.69 billion expected. Go ahead, Dave. You got something to say?
I do. I mean, you said you just glaze over the soft housing market. The housing market, as far as new mortgage applications, hasn't been this low in over 29 years. So don't just say soft. Like, this is a down market. Nobody is applying for mortgages unless they have enough money to cover the high interest rate, or they're doing that 2 and 28 loan plan, which is not very good idea to do, but they're hoping in 2 years that interest rates will come back down, which I think is really over guessing on that. They need to have more than 2 years for it to come back down to a 2% or below level. But yeah, it's a bad, the mortgage industry right now, and the housing industry is in a bad shape. So I wouldn't glaze over that so much as quickly as you did in regards to Lowe's, and especially when it comes to Lowe's and Home Depot numbers. But go ahead, continue with Lowe's. And
The only way that happens at 2% is if we have a severe recession again and the Federal Reserve steps in and starts buying up mortgages and lowering interest rates. That's the only way it happens. Gross margins were 32.3% for the quarter. This was lower than they were a year ago, but that's still not bad. They said that shrink or, items that are shoplifted, that's, retail speak, stolen by employees, lost or damaged, that shaved off 0.3% gross margins, and that was worse than expected. I think that like shrink across retail just for the past 2 years has just been really bad, and inflation has actually made it more profitable for people to steal, and it's also made it more necessary for some people to steal. But I do see, if you're going to steal a loaf of bread, it's different than stealing, a Nike shirt or something like that, or Nike shoes or whatever. Anyways, for fiscal 2023, Lowe said it expects total sales between $88 billion and $90 billion. This was compared to Wall Street expectations, which was already conservative for them, of $90.48 billion. Company expects same store sales to be flat or down 2% for this year. Go ahead, Dave. I cannot hear you. Do you have yourself muted?
I do have myself muted.
Yeah.
I'm sorry. I pulled that. Oh man. And I'm on so many meetings every single day. All right. So this whole shrink thing that all these retail companies are coming out with their earnings calls and saying, "Oh, shrink's causing this and shrink." It's like this year's Ukrainian thing. Like last year, everybody said, "Oh, we couldn't hit numbers because of Ukraine," when their business had nothing to do with Ukraine. So I think this whole shrink thing is just another retail. I mean, you and I have talked about the shrink thing before, how it has jumped up. But I keep pointing out, yes, in these companies that it has jumped up with, it's only still a small percentage. It hasn't gone from like 2% to 20%. It's still around those low single digits. It's not a majority of their losses is not from shrink. It's the new Ukrainian play from retail companies.
It's what, they've adjusted prices upwards for that. Being somebody that was in retail management in the past couple of years, I just, I witnessed two 11-year-olds walk off with BB guns. I'd never seen anything like that before. The BB guns were taller than them.
Right. And I've done retail management as well in my years past, as you well know. It's part of the business, and every one of these retail companies should factor that in to their business.
Absolutely.
And most companies do. In fact, Walmart just factored in so much that they gave up on trying to stop it for a little bit there in their history, and they
everybody's given up on it. Everybody's given up on it. You don't stop anybody anymore.
Yeah.
You don't stop them. You're told not to because you don't want to risk your life. We just had a few months ago somebody here, and the Walmart near me got shot because he was trying to stop a thief. So you can't really blame them for that, but.
So it's all worked in, is what I'm saying is, and that should not be like the first thing out of a CEO's mouth on an earnings call, is my point, when they're trying to justify why they failed on the numbers. I want to hear, okay, give me the other reasons. What's the actual numbers here? Where did you not hit your mark at?
Inflation, higher interest rates, and caution from consumers, and all of that was reasons given, plus reasons for why they are guiding down for this year. And they say a slight decline in the overall home improvement market. With that being said, look what they're going up against last year and the year before. The home improvement market was huge. So, comparables are going to be tough here. Go ahead. Go ahead.
You just keep saying stuff. You keep saying stuff that I want to respond to right away. I'll give you that. Yes, the comparables are going to be very tough to the past 2 years, especially in Lowe's and Home Depot. But what does interest rates has to do with Lowe's? How is that affecting your business? Inflation, yes. Consumers stopping buying as much, yes. But doesn't Lowe's and Home Depot, like you pointed out to me on one call, we were talking about Home Depot, and you pointed out to me that they get a lot of their business from small businesses, correct?
Yeah,
and that's where both of these companies get a lot of their business from.
But those small businesses that are home builders and construction companies that are not building as much because the interest rates on their products are going higher.
So the loans are taken out to run their businesses. So not
only that, but like also interest rates on housing for consumers to buy the house at a higher interest rate right now. It's a tougher decision for consumers to make.
So you think consumers should be at home improving the houses instead, and that's the thought process. But I can see the small business aspect, because you take a small mom and pop construction company that builds custom homes, which there's are a number of them in any major city. Guys, look around, look this up, check me if I'm wrong. But what they do is they take out a loan to build this house, and then when they sell it, they make their profit and they pay off the loan. So what you're saying is that these higher interest rates are making these companies a little more hesitant to take out these loans, and they want to try to finance more in a different avenue or way. And that's hurting Lowe's numbers. Is that what he's saying? Is that kind of where he's going at with these CEO?
Let me finish off this quote here, because it'll shed a little bit more light on it.
All right. I'll stop interrupting. Go ahead.
So this was the CEO, Marvin Ellison. He says, given the slowdown in housing turnover is driven by, given the slowdown in housing turnover is driven by higher rates and slow supply rather than demand, we continue to see a nationwide trend of trading up in place, with consumers opting to upgrade their existing home to meet their evolving needs. So what he's saying here is actually like the upgrades, the renovations and stuff like that that will happen because people aren't buying new houses, upgrading what they have. That's going to provide a level of support to Lowe's, right? But he says all these dynamics give us confidence in the medium and longer term look for the industry. With that being said, we also know that consumers are wary of a potential recession, which is reflected in the discretionary pullback we've experienced this holiday season.
You know what's funny is this is not the first retailer in the past 2 weeks to talk about how to come out and their fourth quarter holiday sales were bad. And in January, they said the holiday numbers were bad. But in December, everybody thought there was going to be a Santa Claus rally because these numbers were looking hot and heavy. And there was all this, oh, it's going to be great. It's holiday sales are going to be through the roof. And it's no.
Well, we got a huge rally in January that just seemed like kind of unexpected and a little weird, just like we did last year.
Right. And that's when, I mean, we had this huge rally. And what was it, like 3 weeks ago? I think it was 3 weeks or 3 shows ago. I came on here and I said, I don't see why this market keeps going up. To me, it looks like and I said, it looks like it's held up. And I said, I even prefaced by saying, look, I'm not trying to sound like Michael Blurry here, but it looks like something's just holding us up fraudulently because I don't see a reason for the market to be up like it is. And sure enough, what happens? The market finally corrects itself back down to a more to where it should be. And I believe there should go lower.
Yeah, I think it's going to go lower market value.
And that's just, and I say that every week I change. Yes, you can say, Dave, well, 2 months ago you were saying something else. Well, yeah, because more numbers have come out, and every week different numbers are going to come out. So every week I'm going to have a different take based on the new information I have from the past week. But I will tell you this: 3 weeks ago I said the market was way too high, and then I said, maybe I'm getting too bearish because it just kept going higher. I'm like, am I the one who's wrong? Am I the one who's crazy? But I see it going lower. I see Lowe's point, the CEO Lowe's here. He's saying we are going to have some support, but we are going to go lower. And that guidance is good. But he needs to be more upfront and honest of where his losses are.
Yeah, Treasury yields are continuing to climb higher too. The 3-year was at 4% the last time I checked, and the market has not priced that in.
You say, I mean, that's not a good sign, man. I mean, come on, guys.
No. Okay. So here, let's just look.
But are bonds dead, Brandon?
Yeah. So let's look at, because I'm going to compare and contrast. Some point in this podcast, I'll get to Salesforce's earnings.
No, you won't.
That'll kind of compare to what I'm getting right here. And that I just want to look at the company versus the stock. The company I like, the stock at 20 times earnings, I don't. For Lowe's. It's up 12% for this year. So if we don't have a recession, 20 times maybe not so bad. But if we're staring down the eyes of a recession right now, looking at a home improvement company, I just say no. I say no.
I just say no because as a retailer, and I don't like retailers right now, and I've maintained that position since middle of last year, and I'm going to continue to maintain that position. I'm not a fan of retailers right now. I'm staying out of the whole sector altogether and sticking to my tech sector that I know, my semiconductors and oil. Those are the sectors I've been making money with right now. Sticking with those.
My only retail holding right now is RH.
And you still holding that? Really?
Yeah, I'm going to hold it for forever.
Really?
Until they prove me wrong. Until
Well,
they,
I mean, RH is not going to, dude. I don't believe RH is going to be around forever.
I think you'll be surprised. I think
I think they're gonna no, they're gonna go.
no, I just like management too much of the company. I think RH is. I think it's a good bet.
If you don't know what RH is, guys, we're talking about Restoration Hardware. RH is the ticker symbol for it. Brandon believes because it's a luxury brand, and you're going to have these wealthy or secure families in the United States still buying from this brand because they don't suffer as much during times of recession or depression. So the business cycle doesn't affect them as much. So that Restoration Hardware could continue to always make a profit no matter what type of year we're having. I disagree with Brandon. I believe that even the wealthy and elite are eventually going to shift to online only or augmented reality ordering eventually.
You've already actually like this has been a recession in itself. I don't let's not call it a recession at the moment because it's so controversial to say that word. But with that being said, this downturn has actually not proven my case. Luxury brands have actually been the first victims, and actually wealthy people have taken a bigger hit than the middle class and the working class in this so far. But
Right?
I
How many
continue to believe in RH's future for sure. I do. I even though I hate their contemporary line, I think it's ugly.
So this is coming from someone who I won't go into what company or anything, but he worked for a furniture retailer for a while, so he knows furniture very
Yeah.
well.
Yeah. All
I
right.
think it's been long enough. You could say it, but I wouldn't if I was you.
It rhymes with idea. All right. Warren Buffett, he Berkshire's annual letter. Okay, I'm stuttering on my words, and I'm not going to edit this, so you're going to get the full thing here. Warren Buffett issued his annual letter, as he does every year and has for like 50 years now. So I just want to go over some of the things that he said and some things that caught my eye, and there's quite a bit actually. So strap in your seatbelts. It's going to be a ride. I'm not editing that either. It was lame, but whatever. All right. So first quote that caught my eyes. Capitalism has two sides. The system creates an ever-growing pile of losers while concurrently delivering a gusher of improved goods and services. Schumpeter called this phenomenon creative destruction. Think of the candle makers when Edison and Tesla invented the light bulb, for example. Think of the horse and buggy makers when the automotives were introduced. Think of all of the automotive companies in the past 100 years that have went bankrupt, while Ford and GM and I almost said gross margin instead of General Motors. That's how far off I am right now. But Ford and GM have made billions of dollars, and now Tesla as well. I'm going to get to my point here in just a second, but the next quote, one advantage of our publicly traded segment is that episodically it becomes easy to buy pieces of wonderful businesses at wonderful prices. It's crucial to understand that stocks often trade at truly foolish prices, both high and low. Efficient markets exist only in textbooks. This is true. I hate it when anybody tries to sell me on the efficient market theory. In truth, marketable stocks and bonds are baffling. Their behavior usually is only understandable in retrospect. So, as a long-term investment, what do you do that what do you do with that as a long-term investor? I said last week what you do is you wait for the people who are picking up pennies in front of steamrollers to get steamrolled, and then you come in and you pick up the leftovers, and that's essentially it. When markets have driven prices to foolishly low levels, that is your time to buy. When Jim Cramer's crying on television about Meta shares being, too low and he was so wrong, that was your time to buy Meta. When everybody on television, print, the Bloomberg media, all of them are telling you to buy, there's blood, or to sell, there's blood in the streets, that's when you buy as a long-term investor. That's when you pick up the pieces, and those pieces inevitably will become gold. Some of them won't, though. You will have probably more losses than you have wins, but your wins over time will grow and grow and grow. And the weeds that were your losses will be overcome by the flowers that were your winners. Go ahead, Dave.
Yeah, and the counter side to that is the same as well. When you get every single analyst alive, and even the TikTok guys going up there saying, "Hey, Goldilocks economy, you can't go wrong. Buy this, buy that. It's all going up." That's when my time when I question I need to be selling, dude. Because especially the TikTok guys. If the TikTok guys are all over it, then you know it's late. So that's just something to think about. I don't know.
So to this point, he says, in 58 years of Berkshire management, most of my capital allocation decisions have been no better than so-so. In some cases, bad moves by me have been rescued by very large doses of luck. And then he brings up US Air and Solomon. So a man that owns up to his mistakes for sure. Our satisfactory results have been the product of about a dozen truly good decisions. He says 12 really good decisions since, what is it, 1969, when Berkshire Hathaway was incorporated.
It was in the 60s. Yes.
Yeah. He estimates that he's had one good decision every 5 years.
That's about right. That's about all you need. If you're a long-term investor like that, one good decision can blow it up for you. I mean, Gillette was an amazing decision by him. That one just made him tons and tons of money. So I mean, one good decision can make up for 9 losses if you're playing it not risky but long-term investment.
In 1987, he started to buy Coca-Cola. By 1994, they were finished with their purchase of 400 million shares of Coca-Cola. The total cost in 1994 was $1.3 billion. The cash dividend was $75 million. By 2022, the dividend increased to $704 million. That does not include the price of the stock going up, obviously, which has made him so much more. And he said growth occurred every year. It was almost as certain as birthdays. All Charlie and he had to do was cash the check. And he says he expects the checks that they are highly likely to grow. And then he brings up go ahead.
I want to interrupt you here because like people are like, well, yeah, but he invested with 1.3 billion. It's easy to make yada yada money and have that sit around. And I'm like, look, guys, Buffett, did not start off his life with $1.3 billion. In fact, I don't believe he was a millionaire till he was 40, right?
No, he wasn't. And Berkshire Hathaway was a failed textiles company that was on the brink of bankruptcy until he switched its operations into insurance.
So, I mean, this guy wasn't even a millionaire until he was 40, and now he's like one of the world's richest men. So, guys, it's never too late. If you're out there listening and, you're in your 30s and you're like, I can never do something like that, I'm like, yes, you can. Yeah. Yes, you can. You just got to be consistent and be steady and make good investments, smart investments. Go ahead, Brandon. Sorry. Yeah.
Oh, no, you're good. Brings up American Express here. Berkshire's purchases of Amex were essentially completed in 1995. Coincidentally, it also cost $1.3 billion, as did his Coke investment. Annual dividends have now grown from $41 million to $302 million a year. Now, he goes on to say, he says, assume for a moment that I had made a similarly sized investment mistake in the 1990s, one that flatlined and simply just retained its $1.3 billion going into 2022. He said an example would be a high-grade 30-year bond. That disappointing investment would now represent an insignificant 0.3% of Berkshire's net worth, and it would be delivering to us an unchanged $80 million or so of annual income. Here's the lesson, he says. The weeds wither away in insignificance as the flowers bloom. Over time, it takes just a few winners to work wonders. And yes, it helps to start early and live into your 90s.
That's actually kind of true there. Yeah.
Maybe I need to get my diabetes thing and do away with that and start working out.
Come work out with me, man. F45 training, guys. Liberty Township. There's another plug for it.
Cigarettes while I'm working out.
No, you need to quit. Anyways, I love Warren Buffett. I've always loved what he has. I've not always agreed with him, I've kind of questioned some of the things he's played, like his Occidental Energy blend, but that ended up turning out to be a good play for him this past last year. So I've questioned certain things about him, but I mean, he ends up being mostly right most of the time. He owns a lot of Goldman Sachs, which that's a solid company there in themselves. But it's he's a smart guy. I don't think his Goldman Sachs play was actually the best now because of they're losing money with Apple and they're losing money with the retailers. I think Warren Buffett's better than Goldman Sachs. So I would, if I had to choose between Berkshire Hathaway or Goldman Sachs, I'm picking Berkshire Hathaway.
Everybody seemed to criticize him for buying Kroger stock. I think it was in late 2019 or early 2020. And since then, Kroger's been, gold for him as well.
Yeah. Oh, yeah.
Let me talk about this. May be a little self-serving here, but I want to talk about something else that I think is gold for him. He says a second positive development for Berkshire last year was a purchase of a company that I recommend everybody buy before the news of Berkshire buying them came out, Allegheny Corporation. And dude, this has got to be just like, I don't know if this is like God telling me I was right or, the angels or whatever, but this guy's name is Joe Brandon. He's
okay.
Allegheny Corporation.
Brandon, it's called modesty, okay, and humility. Come on now, learn them. No, I'm just kidding. Go ahead, boast, go boast. You deserve it. You deserve it.
Another thing that I think he did really well was buying Allegheny Corporation, as evidenced by, you can go back and listen to the episode that I said buy this company, and then like 2 weeks later he bought it. I think Warren was listening to us, Dave. I think Warren Buffett is a listener out of Omaha, Nebraska. For sure.
It's either him or my sister, so one of the two. Yeah, Warren Buffett, if you're listening, throw me $1 billion.
Brandon says Allegheny's a good buy right now. Maybe we will go buy it. I'm pretty certain that's what happened. That's exactly what happened, actually. That's what I'm putting in my memoir.
Can't wait to read this memoir of yours. All right. So what else did that Buffett say in his letter, man?
Anything else? Allegheny delivers special value to us because Berkshire's unmatched financial strength allows its insurance subsidiaries to follow valuable and enduring investment strategies available to virtually all competitors. Now, about stock buybacks, he says the math isn't complicated. When the share count goes down, your interest in many businesses go up. Every small bit helps if repurchases are made at value accretive prices. Just as surely when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and the friendly but expensive investment banker who recommended the foolish purchases. When you are told that all repurchases are harmful to the shareholders or to the country, or particularly beneficial to CEOs, you are listening to someone who is either an economic illiterate or a silver-tongued demagogue. And he says these are not mutually exclusive characters.
Now, all right. So I want to first of all come on here, and before you say a word, I want to say I don't want this program to ever be political. This is a stock financial investment podcast. This is a disagreement that Buffett has with the current administration and the language they use against stock buybacks. Now, I will preface this disagreement that they're having in that both are outspoken Democrats. So it is literally two Democrats arguing with each other about this. So it is not a Republican versus Democrat argument here. And I understand you're reporting on it. CNBC reported on it. Bloomberg reported. I read this article 50 times a day by different organizations. Everybody reported on what Buffett said and that how he attacked the current administration in saying that repurchases were bad for the country and the everyday American people. And I actually agree with Buffett here that repurchases are not bad for the everyday person and the country. It actually helps the company more stable financial footing so that they can better serve their employees. You're on mute.
Sorry about that. I criticized Meta's buyback program only because of the timing of it when they announced it in their latest quarterly earnings. I just thought it was bad taste to lay off, millions of people and then announce a stock buyback program. So I can kind of understand where some people come from with this, and I think that Meta should have held off. Quite frankly, it was, I don't want to say insensitive, but just I think it was wrong-headed timing for it. But it helped my stock go up. That was great, but
That's one company out of how many that do stock repurchases. I mean, come on. You're always going to have a small percentage of exceptions that do it wrong or do it badly or poorly or poor timed. There's always going to be those exceptions to the rule. That's just humans and humanity and how we get through our existence here. But in the end, I think Buffett's right in what he said.
And if they're doing it right, they're leveraging the buybacks as a reinvestment into their own business rather than a tool to just increase the share price and the CEO's ownership of a company.
Yeah.
There's some differences here. So some companies do it as an investment. Others do it for the optics of it to increase investor excitements and just to raise the price of the stock. And then there's also going to be some others that will do buyback programs in order to shoulder some other board members out further of the company or to try to stave off a hostile takeover.
So if you guys don't understand how these all work together, there's a great HBO show out there called Succession, that really delves into it. It's got some other, not family friendly, by the way, but it's got some other issues there with the show, but they delve into the business aspect and cover it very, very well. I love that show.
So yeah, this is where your research comes in. Are they buying back? And most companies are, honestly, they're buying back because they believe that the stock's undervalued. And if that's the reason why they're doing it, then that's great. That's a good sign for you as an investor. The other two things that I just mentioned are not. You just don't touch those companies, like possibly ever.
Right.
All right.
Like go ahead.
That's it for the Warren Buffett letter. I do have some on Salesforce here.
Oh, do we have to get the Salesforce? Because I was hoping you're going to talk about Microsoft. Joking.
There's been a lot of drama at Salesforce, though.
What is Salesforce business? Because people hear Salesforce and they think one thing. How would you describe their business?
Data analytics for businesses.
Yeah, it's more like a Workday or an Okta, wouldn't you say?
Yeah.
Like a Kronos, a Workday. Those are systems most people are used to.
Yeah.
Salesforce is similar to those type of systems.
Yeah, it is. And there's a lot of people in the space. There's a lot of companies in the space. There's Microsoft. They've got Power BI. There's IBM. There's so many people in the data analytics crowd trying to help people interpret the numbers for their businesses now. So it's a pretty crowded market. Lots of competition for Salesforce, for sure. And for a while, their strategy was to try to buy up their smaller competition and to increase their size. And if you listen to the very first episode of this program, I used to be a huge fan of Salesforce. Part of the reason was because I love the company, I love the company and I love the product so much. I got that confused. I was just talking about Lowe's earlier in this podcast where I said, let's look at the company versus the stock. And my mistake with this was that I liked the product that Salesforce has to offer so much, I let it cloud my judgment for the stock. Once I discovered that they were making their purchases of other companies by selling shares of their own company to raise the capital, and then I also realized in the past too, you can hear some of the past episodes of me talking about Mark Benioff and some of the board members selling shares before they would announce purchases of, Slack or Tableau, for example. And that rubbed me the wrong way as well. However, just recently, activist investor Elliott Management has nominated a slate of directors to Salesforce's board, according to CNBC. That nominating window closes March 14th. It's unclear if there's going to be 2 or 3 nominees. They unveiled their multi-billion-dollar investment in Salesforce 2 months ago, back in January. And they said that Value Act Capital CEO Mason Morfitt is also going to be on the board. Dan Loeb's hedge fund, Third Point, has also built a position here. Lots of activist investors who see the value in a good product, but not very good stock management. So slowing revenue growth of late, and there was also criticism for buying companies such as Slack and Tableau at high multiples. And they even did the Slack acquisition after they told shareholders that they were done with acquisitions. So, a lot of upset shareholders here. And I think it's a good thing that activist investors have gotten in charge, have gotten their way with this company right now, because now they're saying their top priority is profitability. And that's a huge deal. They've also disbanded their M&A board. So, good news. I think that's good news. The stock's up like 15% right now after hours on earnings. Earnings per share came in at $1.68 versus $1.36. So they beat on that. They beat on revenue too, 8.83 billion versus 7.99 billion. So they beat on that as well. Revenue grew 14% year over year in the fiscal fourth quarter. They reported a loss of $98 million though, but this was compared with a loss of $28 million a year before. Still losing money here. But there is an upside. Mark Benioff said 6 months ago in September at our Dreamforce Investor Day, we shared our comprehensive transformation plan, the new day for profitable growth, but things have changed. We've entered our fourth quarter. We recognized that we needed to radically accelerate the transformation time frame. We need to press the hyperspace button and bring 2-year goals forward quickly to exceed them now. And now the adjusted margin was reported at 29.2%. This is the highest in the company's history, and their goal was 25%. So they're meeting on their goals for this at least. Go ahead, Dave.
So the good news is they're meeting on their goals. They blew away numbers, but I think that has more to do with their acquisitions of Slack and Tableau. Slack is it was profitable company when they bought them. And I believe Slack is really what's driving this profit. So, and I give you the example of Tesla.
$30 million for the acquisition, though, if I remember correctly.
It's profitable. I'll give you the example of Tesla bringing in Solar City underneath its wing. When Tesla did that, they brought in a profitable company under its wing and made it part of Tesla. So now Tesla became quickly more profitable quicker because of bringing in Solar City. So that helps with Slack as well, because now with Slack, they cut the mergers, acquisitions, they better manage the selling of shares and the movement of shares. All of this helps to make a company. So they're making the right decisions. I agree with you on the outlook going forward because of the decisions they're making. Now, if Elliott management cannot get those 3 board seats, then I would be concerned. So right now it's a gamble. It's a gamble because it gapped up at 15% up. That's a big gap up. I wouldn't buy off a gap up off of a gamble that Elliott management's going to get these board seats. Now, if you believe in the long term without Elliott management getting the board seats and you still believe in the company without that happening, then okay, maybe you can buy a long-term investment here. But if you believe that Elliott needs those board seats in order to see your growth opportunity above a 15% gap, then I would not buy here. I would wait and for it to fall back down.
Company's in a show me state. At least the stock is. It's in a show me state. And in other words, it needs to show me that it can do the things that it's talking about doing. Because in the past, we've heard no more mergers and acquisitions, no more debt spending, and they just continue to do it.
Yeah.
Now, here's another one. They're working with Bain Capital on a review of the business. So there's a lot of different companies coming in here right now to try to get this thing on track.
Man, you got Elliott Management and Bain Capital. Bain Capital has a long history of producing 80% returns for its investors. Yeah. That company, if they're coming in, they're hoping for a big return on investment if they're coming in. For sure. And so that gives me some confidence behind it, just because I know Bain Capital, I know the history of Bain Capital.
Did Did they have to name their company after a Batman villain?
I don't know if that was the reason why they named the main capital, but yeah, there you go.
All right.
There you
That's
go.
all I've got.
Salesforce. I mean, I agree with you. It's a show me. Definitely. Let me see some numbers. Let me see if Elliott Management can get these board seats they're talking about. That would make me have more confidence in the company in order to say it's a buy.
Okay. Elliott Management just released a statement. Said
Oh,
Elliott has been in close substantive dialogue with Salesforce leading up to today's earnings statement. Salesforce set of announcements today represents progress towards regaining investor trust, the acceleration of margin targets, commitment to responsible capital return priorities, creation of a business transformation committee, and disbanding of the M&A committee are all necessary steps forward. There's more to that if you guys want to look it up, but I'm not going to read it because Dave thinks I'm getting boring here.
I was not falling asleep. I was just pretending I was. Yeah, no. So there you go, man. There you go. Final thoughts. What do you got, man?
Show me for Salesforce again. I was fooled once on it. I don't know, man. I really I've used the product before. I really like the product. Very, very, very competitive industry that they're in. Show me what you can do. I do not like buying a company that's lost $98 million in the last year, staring in the eyes of a recession with increasing interest rates.
All right, guys. My final thought is a lot of the headlines today, because you know me, I'm a headline guy. I'm a day trader. A lot of the headlines today were all about the Fed is not winning this inflation fight right now. That's where I saw a lot of headlines right in there. That's something we have said consistently, that I keep looking for rates to fall below 6%, and they're not. They're holding tight at 6%. It's not a good sign there. As far as the inflation in Europe, that's a different story, and it has to do with the Ukraine-Russian battle and the oil pipelines, Nord Stream pipelines, the sabotage that happened there, or accident, whichever one you want to believe. That pipeline is still going to have issues because there is still a lot of fighting going on in Ukraine. I follow the battles there because I look at it as an oil play. That if they finally get some peace and it looks like things are going to turn around good, oil will drop in price because Russian will lose their sanctions. However, with the fighting growing even fierce and Putin really pushing harder, I believe that that's going to continue the sanctions on Russian oil, which is going to continue the high inflation on oil and gas in Europe, which is going to continue the cost of oil to be higher than what it should be at this time. Oil should have been sitting around 50, 60 bucks a barrel. Instead, we're still sitting around 80, 90 bucks a barrel right now. So that's a huge difference in price. I believe we're still going to see that for an extended period of time. I don't see an end to it this year. So that's my call on oil this year. We're not going to see an end to these prices of oil. It's because Ukraine and Russia are not going to end it this year. Unfortunately, it would be great. I don't see it happening based off the articles I've been reading on this. I don't believe any of the other headlines today really have any big effect. There was a little bit about Tesla stock. It went down because there wasn't much detail given on their investor day that they happened today. Musk talked about a Mexico plant that he was going to build in Mexico, cheaper labor, and going down to Mexico to ship it right across the border. I think that's a good idea to build plants in Mexico rather than China. It's still cheaper in China, but I believe in Mexico it's a little bit more closer and more able to be controlled by American companies. If I was the owner of an American company, that's where I would want to go.
Do we have a release date for the Cybertruck yet?
I did not see one on the articles I read today.
Okay.
Are you looking to get a Cybertruck?
I want one.
There you go. See, I want the personal plane helicopter thing. That's what I'm waiting for. I could just fly around everywhere. You guys can drive. Peasants. That was a joke. That was a joke if you're listening right now. All right, so that's all we got, guys. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.